The 2% fee that cost me $250K. Avoid this regret. I started with a $500,000 portfolio and a solid plan to retire in 25 years. But a tiny 2% fee, recommended by an advisor I really trusted, silently siphoned away $250,000 from my future. In this video, I'm going to show you exactly how this happened, and more importantly, how you can avoid my massive regret. The dream that wasn't. It all started about a decade ago. I'd come into a significant amount of money, a $500,000 nest egg that felt like my one-way ticket to financial security. I wasn't a stock market genius or a financial wizard. I was just a regular person who wanted to do the right thing with this once-in-a-lifetime chance. My goal couldn't have been simpler. Invest it, let it grow for 25 years, and build a comfortable retirement. So I did what you're told you're supposed to do. I found a financial advisor. He was professional, had the fancy office, and came with glowing recommendations. We sat down, and he laid out this sophisticated-looking plan. He threw around words like diversification, risk tolerance, and long-term horizons. Honestly, it all sounded incredibly reassuring. A wave of relief just washed over me. I thought, great. I have an expert in my corner. My money's safe. I signed the paperwork, handed over the keys to my portfolio, and for years I barely gave it a second thought. I'd get my quarterly statements, see the numbers bob up and down with the market, but I trusted the process. I was playing the long game, and I had a professional flying the plane. What could possibly go wrong? Well, the truth is, while I was busy living my life, a tiny, almost invisible leak was slowly draining my fuel tank. And I had no idea I was heading straight for a financial storm. The silent killer in your portfolio. The problem was hiding in plain sight, buried in the fine print of my agreement. A 2% assets under management, or AUM, fee. Now, if I told you a fee that small was quietly costing you hundreds of thousands of dollars, you'd probably think I was exaggerating. 2% sounds like nothing, right? It's just 2 pennies on the dollar. When my advisor explained it, it seemed totally reasonable for the expert guidance I thought I was getting. But let's break down what that actually means. On a $500,000 portfolio, a 2% fee is $10,000. Every single year. That's not a one-time charge. That's an annual payment you make, whether your portfolio goes up or down. 10 grand is a family vacation. It's a huge chunk of a new car. It's a serious amount of money. But since it's quietly pulled from your investment account, you never really feel the sting. You don't write a check, you just see a slightly smaller number on your statement. For a typical financial advisor, the average AUM fee is about 1%. My 2% fee was at the absolute highest end of the spectrum for a standard portfolio. To be fair, some alternative investments like hedge funds have historically used a 2 and 20 model, which includes a 2% management fee, but that's a totally different ballgame for very different investors. For a regular retirement investor like me, 2% was a fee that, as I'd later discover, was delivering nowhere near the value I was paying for. The slow motion heist, my $250,000 mistake. My aha moment didn't come from some dramatic market crash. It happened on a quiet Tuesday night. I was reading an article about the impact of fees on retirement savings and, mostly out of curiosity, started playing with an online investment calculator. I punched in my numbers: a $500,000 starting principal, a 25-year timeline, and an assumed 7% annual market return, which is a historical average, not a guarantee. First, I ran the numbers with my 2% fee. Now, the math isn't quite as simple as 7 minus 2, but that fee effectively dragged my net return down to around 5%. Over 25 years, my $500,000 would grow to about $1.7 million. Not bad, right? But then my heart sank. I ran the numbers again, this time using a more standard 1% fee. With a 6% net return, the final portfolio value was over $2.1 million. The difference was a staggering $400,000. Even just comparing my 2% fee to a still pretty high 1.5% fee revealed a difference of over $230,000. This is where my $250,000 regret comes from. A tiny 0.5% difference that I had blindly agreed to was costing me $250,000. And when I compared it to what I might have paid with low-cost index funds, where fees can be as low as 0.14%, the loss was just astronomical. This is what the experts call the tyranny of compounding costs. I call it a leaky bucket. It's not just the money that's taken out in fees each year, it's the future growth that money never gets a chance to generate. That $10,000 taken in year one isn't just $10,000. It's the $40,000 or $50,000 it could have become over the next 2 decades. I had been so focused on the market going up and down that I completely missed the enemy inside my own portfolio. It wasn't one big hit, it was a death by 1,000 cuts. Why we fall for it. So, how does this even happen? How do smart people end up paying these wealth-destroying fees? I've thought about this a lot, and it really boils down to a few things. First, trust and complexity. The financial world can feel intentionally confusing. When a person in a nice suit starts throwing around jargon, our eyes kind of glaze over. It's easy to feel out of your depth and just trust the expert. We assume their fee is justified by some secret knowledge or that they have access to special investments we can't get on our own. Second, there's a serious lack of fee transparency. Fees are often buried in long agreements or split into different parts. You might have the advisor's AUM fee, but then you also have the internal expense ratios of the mutual funds they put you in. When you add it all up, your total fees can easily creep over 2% or 3% without you ever realizing it. And finally, there's plain old inertia. Once you're with an advisor, switching feels like a huge hassle. There's paperwork, awkward breakup calls, and the stress of finding someone new. So, we just stay put, even with that nagging feeling we might be overpaying. I was guilty of all three. How I took back control. Seeing that $250,000 gap lit a fire under me. I knew I couldn't just keep letting my retirement dream get eaten away by a percentage point. My first step was a tough phone call with my advisor. I asked him to justify, in simple terms, how his 2% fee was adding more value than a lower-cost option. I asked for a full breakdown of my all-in costs, including the expense ratios of every fund he'd chosen. The conversation was uncomfortable, and the answers were completely unsatisfying. He talked about active management, but the reality was my portfolio was just tracking the market, minus his huge fee. That pushed me to finally educate myself. I dove in and learned about low-cost index funds and ETFs. These are funds that don't try to beat the market. They just aim to be the market by tracking an index like the S&P 500. Their secret weapon? Incredibly low fees, often under 0.2%. I had a realization. I was paying a premium price for active management that wasn't actively doing anything but draining my account. So I made a change. I moved my portfolio to a low-cost brokerage and invested in a simple, diversified portfolio of index funds. It was scary at first, like taking the training wheels off a bike. But it also felt incredibly empowering. For the first time, I was actually in the driver's seat of my own financial future. Your 3-step action plan to avoid my regret. I made this video so you don't have to learn this lesson the hard and expensive way. If you have a financial advisor or are invested in mutual funds, I want you to do 3 things as soon as this video is over. Step 1. Become a fee detective. Pull up your latest account statement. Look for any line that says advisory fee, management fee, or AUM fee. Then, dig deeper. Look up every single fund you own and find its expense ratio. Add it all together. You have to know your all-in number. Step 2. Calculate your real cost. Don't just look at the percentage. Use a free online investment fee calculator. Plug in your portfolio balance, that all-in fee you just found, and your time horizon. See for yourself what that fee will cost you over 10, 20, or 30 years. That number will probably shock you. It's the number that changed everything for me. Step 3. Ask the hard questions. Schedule a meeting with your advisor. Ask them point blank, can you tell me in a single dollar amount what I paid in total fees last year? And then ask the multi-million-dollar question. Can you show me with data how the value you provided was greater than that cost? If they can't give you a clear, compelling answer, you need to seriously reconsider the relationship. Navigating these conversations can be intimidating. If you want to be armed with the right questions to ask, I've made a whole other video on the 5 questions you must ask your financial advisor before hiring them. It's a complete guide to help you interview and evaluate an advisor to make sure they're actually working for you. The link is right down in the description. That 2% fee felt like nothing at the start, but it was a quiet promise to be poorer in the future. It was a guaranteed headwind blowing against every single dollar I was trying to grow. The single biggest factor in your long-term success isn't picking the hottest stock or timing the market, it's minimizing your costs. Don't let a tiny percentage rob you of the future you are working so hard to build. Take 1 hour this week to investigate your own portfolio. It might just be the most profitable hour you spend all year. You are your own best financial advocate. It's time to start acting like it.